Good morning and welcome to this Thursday, October 12th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we prepare for the trading day ahead. Well, we've got inflation out of the way, at least for another month. Yesterday, we had the PPI, the September PPI Producer Price Index come out. It was what matched expectations at the core level, which is what the Fed pays attention to most. And then this morning, just about 30 minutes ago, we had the September CPI come out, and it was as expected, rising 0.3%. So we've got now 4 CPI readings in a row at the core level that have been at that 0.3 level or below, which is getting pretty close to what the Fed's target rate is. That's 4 consecutive months. So not only is the annual rate continuing to decline, but we're also seeing it move more and more back toward where the Fed wants it to. So I think this is another step in the right direction in terms of eventually ending the rate hike cycle and potentially starting to look at when the Fed is going to begin cutting rates. So far this morning, I think the reaction was pretty good. Let me give you the latest. Things can change in the morning, especially after a big report. So I want to go straight to the current prices. Right now, the diamonds, the DIA, rising about a little more than 0.2%. The spider up almost 0.2%. The QQQ, which tracks the NASDAQ 100, rising 0.1%. And the IWM, which tracks the Russell 2000, currently we're up about 1/3% there. So all the major indices are up. They're down a little bit off of their recent highs this morning. So after the announcement came out, we did have a little bit of a pop to the upside, but we're kind of moving back a little bit, but still in positive territory as we approach today's open. Honestly, I think this is good news. The fact that it wasn't bad news is good news. It wasn't anything great, didn't come in better than expected, just like the PPI yesterday. But I think the CPI is showing for a 4th consecutive month that we're not seeing any major inflationary pressures at the core level. And I think that's going to bode well in terms of Fed speak, or at least you would think so. But maybe we have another change in heart. And who knows what the Fed has to say in the next meeting, next go round. But let's go ahead and take a look at what happened yesterday first. And I've just got the summary up today. This is the market overview. This is actually where I start a lot of times, this and the sector summary. So we'll go through both of those real quick. Just give you a feel for what happened yesterday. You can see a lot of green, not big green, but green nonetheless. That was 4 days in a row for the S&P 500 to climb. Yesterday, it was up 0.4%. The Dow up a little bit less. That was 0.2%. Wanted to see if I can, there's some way, make this a little bit bigger for everyone. Yeah, that's not the way I was looking for, but that'll work for now. Anyhow, S&P 500 up 0.4%. The Dow up 0.2%. The NASDAQ rising 0.7%. And then small caps and mid caps both up, although they lagged a little bit yesterday. But look at the VIX, the volatility index, down almost another full point, down to 16.09. That's 5.52% now to the downside yesterday on the VIX. And if we pull up the VIX chart, again, let me go back to a regular size chart here for just a second. But if we pull up the VIX, you can see 6 consecutive red or black filled candles, meaning the VIX is closing below it opens, and that's 6 days in a row. Notice how that's so much different than what we saw at the end of September when everyone was much more fearful throughout the day. The VIX was generally rising, finishing at or near highs most of these days. Definitely a different environment these last 6 days as the market has rebounded and we've gone back up. We've reclaimed 20-day moving average. NASDAQ's above both the 20-day and the 50-day moving average. I'll show you those charts in just a couple of minutes. And the VIX simply falling apart here, back down this morning, maybe at the open, depending on, I don't know if it gives me the VIX pre-market. Check this out. And it doesn't give me. But anyway, it looks like about 2 weeks ago, we hit a low of 1583. We closed yesterday at 1609. So if we drop, maybe not even, a little more than 1%, probably closer to 2%. A 2% drop on the VIX is going to take us down to the lowest level we've seen since back on September 21st, which, if you remember, was the day after the Fed meeting. So all of a sudden, all that fear that was in the market after the Fed meeting has basically dissipated. And throughout this entire process, while the fear was building, we already know money had been rotating into more aggressive areas of the market. So I mean, the way I read this is that, number one, the fear clearly is coming out of the market. Also, the 5-day moving average of the equity only put call ratio, might as well take a look at that. And I'll show you what you can, I didn't want to do it that way. You can see, actually, I want to take a picture of something before we go any further. I always like to have this for my records, and I forgot to do it, so bear with me. I'm over at the cboe.com, and if you go into market statistics under that data access, then you can come in, hit market volume. This shows you all the equity only put call ratio. Yeah, the reason I wanted to do this, for whatever reason, on Wednesdays, we did this last October and November, and we're doing it again this year. On Wednesdays, there seems to be something going on in terms of portfolio managers or hedge fund managers building equity position or equity put positions in some of the bigger names, many of the large cap names like Apple and Microsoft and Tesla and Amazon and Meta and Google and NVIDIA, that whole bunch. And we saw it again yesterday. Notice the put call ratio. This is a cumulative reading of the equity only put call ratio, and see how it's pretty steady in the 60s. And all of a sudden we get a jump to 113, 137 cumulative. And so all of a sudden in the middle of the day, this is 12 o'clock Central Time, so it would have been 1 o'clock Eastern, there was a spike of about 465,000 puts and only 64,000 calls. So if you do the math, that's going to be more than 7-to-1 in terms of the equity only put call ratio for that half-hour reading. 7-to-1. That's crazy. And if you look at the next half-hour reading, that's another 338,000, or no, 328,000 versus 76,000. So that's probably, I don't know, maybe another 4-to-1, 4-to-1, 5-to-1, somewhere in that range. And so we go from this 0.68 to 1.37 in an hour. And what I like to do is go back and adjust those. I have a user-defined index, because what I want to gauge is the fear level of the retail trader. These aren't retail traders buying puts at a 7-to-1 clip over calls. Historically, 1-to-1 is like panic mode. 2-to-1, 2.5-to-1, going back 20 years, is probably about the biggest half hour that I can recall if we strip out some of these crazy readings that we're getting. So I wanted to take a picture of that because I want to go back and adjust these two numbers. And let's see, looks like even toward the end of the day, might have been a little bit more that need to be adjusted as it went up again around maybe around 3:30 or so. Anyhow, I just wanted to, thanks for bearing with me there while I did that, because I wanted to make sure I had that data so that I could make that adjustment. Anyhow, let's go back now where we were. So scrap all that. And so anyway, so here's the CPCE, and here's that 1.04 reading. So this is going to skew everything because this number should be lower. Look at these readings. This is what happened last year. I think I said October, November. It may have started right here in October, but maybe it was November into December. I think it was right in here. So this is like the second time in the last week that I've noticed that we're having some big readings. And when you think about it, this equity only put call ratio should be spiking significantly when the market is making a big sell off. That's when panic occurs. You don't panic to sell when the market goes up. Look at the S&P. Let's take a look at the S&P 500 on a 5-day, 10-minute chart. This was yesterday. Look at what was happening in the last half hour. Who would be pouring in at a whatever that clip was in the last half hour, 3-to-1 ratio or whatever it was? Who would be pouring into puts with the market melting up at the end of the day? It makes no sense, even during the day. I mean, I think it was like 1 to 2 o'clock or something on an Eastern. I mean, yeah, we were going down, but it's not like we were free falling. There should have been no panic. We're still in a nice uptrend where we've got higher highs and higher lows. Well, yesterday, higher lows, not exactly higher highs. We didn't get to a higher high yesterday, but this isn't panic mode type of thing, type of environment. So something's going on in the CP or CBOE readings and the CPCE reading at stock charts, the equity only put call ratio. So anyway, I just wanted to kind of point that out because that was part of my VIX discussion, talking about sentiment and how the VIX is coming down, fear is coming out of the market. Well, the 5-day moving average is actually starting to come down if we eliminate some of these hedge fund related purchases on the put side, the equity put side. And normally hedge funds and portfolio managers will, if they're going to hedge, they normally do it with index funds. They don't go into individual stocks. So that's kind of just something strange that happened last year. It looks like it's starting to happen again. And for some reason, if somebody has any information on this, I would love to know. You know, if you can send me an article, you can send it over to support@earningsbeats.com. But if you find an article anywhere that talks about what's going on in the equity only put call arena, because this is now the second Wednesday in a row. It was last Wednesday that the exact same thing happened. And last year, there was an article that came out and said that there were hedge funds that were buying a lot of equity puts, skewing the equity only put call ratio. But anyway, if anybody sees anything about that, I'll be looking for it as well. But if you do stumble across it or you see anybody talking about it, please send me a link to that article. I would really appreciate that because I do want to try to get more information on this just for my own knowledge in terms of tracking that equity only put call ratio. But I think the right thing is to take out those readings. I mean, just make it so that it's more plausible. I mean, we were at 0.65 most of those readings, and then all of a sudden the cumulative went up to 137 because of a 7-to-1 reading. What I will normally do is just go back and adjust that half-hour reading as if it came in at like 0.7, because there was no reason for that huge spike. And then so I'll recalculate the daily equity only put call ratio. Hold on one second. All right. Well, let's keep moving. Hold on. Still not quite there yet. Give me about 15 seconds here. All right, let's try this again. I don't know why it is, but I think it's, for me, it's like October and November. I whenever I go out and do anything with the leaves, that's my allergies really kick in. So I think it's that time of the year when the allergies really starting to kick back in again. But anyway, we'll battle through it as we always do. Let's keep moving. And I had something in mind. Oh, I wanted to go in and show you the sectors. So let's go back over to the dashboard and we go down member tools and scan down to the sector summary. And then here's the sector summary. And this gives us a little bit of an idea of what transpired yesterday beneath the surface. So looking at the S&P, the NASDAQ and all that's fine. But what was, driving the strength yesterday? And when we look, real estate and utilities, two defensive groups. Now you might say, oh, well, that's bad. That's bad news, right? Well, if it keeps going like this, the market keeps rallying with these two leading. Yeah, that would be bad. But right behind them, leading the market still on a relative basis is technology, communication, services, industrials. Discretionary went up about the same as the S&P 500, about 1/3 of 1%. Financials lagged a little bit. Down at the bottom was healthcare, consumer staples, and energy. So this really wasn't a horrible lineup. And to be honest, I think real estate and utilities, with rates coming back down, the 10-year Treasury yield, that's that soaring of the yield is what really has impacted negatively those two groups. So it makes sense that as long as we've got yields coming back down, that these two groups would do well. And by the way, right now we have the 10-year Treasury yield up 2 basis points. 4.61%. We've got crude oil, which is up $1.50, back above, just barely above $85 a barrel. Crude oil up about 1.84%. So I would expect that we'll see a little lift today in energy, the energy shares, many of the energy names, based on the fact that we are rebounding in oil. All right, moving on. Let's move on to the 10-year Treasury yield. So today, you can see when the announcement came out, we did gap down in the yield. So there were a lot of buyers, but now we're reversing. The question is, do we reverse all the way back up to the high? Because after we saw that long tail to the top and that false breakdown that we've talked about this week, once we saw that, very similar to the one we had here back in May, we went quickly back down to the 20-day moving average, slightly below, and then rose right back up again. If you look at this, it's been identical, moving down for 2 days, testing that 20-day moving average today, going below it, now rallying back up above it. Do we rally back to that 480, 490 level to test the recent highs? If so, the stock market's going to get another challenge. We know what's going to happen probably to utilities and real estate because they don't like the higher yields, clearly. But what happens to many of those growth names? Do they really believe in the Fed story that inflation is worth a lot of our attention, and the fact that rates are going to stay higher for longer? That should be impacting areas like technology negatively, and it's not. And I've said it's for a couple reasons. Either number one, the rates aren't going to stay up like the Fed says, or number two, the economy is simply strong enough where these technology names are growing at a rate fast enough where they can absorb higher interest rates. It's one of those two. We're going to find out over time. I believe that they're staying up because the interest rate story is not going to stick. That eventually, I don't think we're going back down to 0 or 1%, but I believe we could go back down into the 3s and maybe be in a range between 3 and 5 for the next several years. I think that's very possible. And we'll see. But that's my theory. I think that's why we're seeing many of the aggressive growth names continue to do well in a rapidly rising interest rate environment, which is counterintuitive, really. But let's keep moving. S&P 500, there we can see back up above. This is the 4th straight day now. S&P 500 just keeps on climbing. Up, up, up. We can take a quick look at see if we're still above. Yeah, we're still up 1/10 of 1%. So we're slowly moving back down, but we are up so far. We'll see whether or not that continues today. But if it does, that would be a 5th consecutive day of gains. Next up for the S&P 500, I mean, now we've cleared 43.05. We've cleared 43.35, which was these prior highs right in here. This was 43.35. I think this was 43.40s, somewhere in there. And then, of course, 43.05 was the August 2022 high that I thought maybe worst case we'd go down and retest it. We actually went a little bit below it, as you can see, but we've rallied back above all those levels. And so now this is starting to give me a much clearer picture of sideways consolidation, not a downtrend. Downtrend, we should have stayed below these 20-day, this 20-day moving average and the others on the major indices and many of the key sectors and industry groups and so forth. And we're not seeing that. We're seeing a lot of these groups bouncing back, getting back above these levels, which I think paints a much more bullish picture. Because if you're bullish, you'll take sideways consolidation over a downtrend. And that's what is kind of being painted here. Also, the VIX dropping, also the equity only put call ratio still elevated. And so that means the market's still generally fearful, which is good. That's a contrarian indicator. So that's what you want. You want people to not believe in this rally, because that's generally what's going to continue it to the upside. So we'll see how the S&P 500 does as the day goes on. But at least for now, we've gotten through the CPI report without any major scare, without a major, upsetting of the apple cart in terms of the release and the actual data. NASDAQ 100 closed on the high yesterday, clearly above both moving averages. Watch that PPO. PPO starting to look like it wants to go positive. That turns positive. That means your bullish momentum in the short term your momentum in the short term is bullish or positive. So watching that. Watching the AD line. Haven't talked about that last couple of days, but as we've been rallying, look what's going on with the AD line. Actually, I want to go back to the S&P. Take a look at that one. Look at this. Going up. Now, if we were rising and it was mostly gap ups, and then we were finishing at or near the low of the day or somewhere in the bottom half of the candle, what we would be seeing is a rally, but a not very good one. And we'd see that AD line continuing to drop. It's not happening. AD line's moving up. That means, generally speaking, this is a good sign of accumulation. That's what this line is. It's accumulation distribution line. It's you use volume as a multiplier, and it's basically taking the volume and either adding or subtracting to this AD line based on where you finish. If you finish at the very top of the day, 100% of your volume gets added. If you finish at the low of the day, 100% of the volume gets subtracted. If you finish right in the middle of the day, there's no impact. The AD line will go sideways. And if you finish on the upper half or the lower half, then there's a multiplier that's used times the volume, and that dictates which way the AD line goes. This is a pretty clear uptrend right now. And if this continues and we get a breakout back above those prior highs, that's good news for the stock market. IWM, you can see moving up, failed at that 20-day. So this is a little different picture. Small cap still a little different than what we've seen on the larger caps in terms of the NASDAQ 100 and the S&P 500. S&P is between the 20 and the 50. The NASDAQ 100 is above both of them. And here we've got the IWM, or the small cap index, below both of them. So a little different picture technically still on the IWM, but this is one that was doing well, a little bit better in pre-market. Let's see if it still is. Nope, back down to even. So right now it looks like the market continues to maybe drift lower as we head for the opening bell. We'll see where we open, and of course see where we go intraday, because that's going to be a big, it's going to have a big impact, I think, obviously, especially given where the IWM sits right on this 20-day. We don't really want to see it roll over with a big red candle like we did here, or like we did all of these days, falling from that 20-day test. Volume's been heavier on this move up. The AD line has started to rise off the recent low. This AD line really looked bad relative to some of the others, which just kind of painted the same picture that I've recently talked about, because I thought the IWM fourth quarter was going to be stronger. Maybe this is starting it. Maybe. We'll see. I haven't looked to see what the IWM relative to the QQQ has done here the last few days. It's still sitting down here relatively low. So in other words, everything's going up by about the same amount, but the IWM was beaten down more to begin with. That's why it's struggling right now to get back through that 20-day. Transports moving back for the second day in a row above the 20-day moving average. Is it a head fake? Do we go back down today? Watch this group. I know one thing. If we do go back down, and I think this is the last gasp, personally, I think this is the last gasp for the bears in the fourth quarter. I think we go higher. But if we do go back down and we do get to recent lows, we're going to see some serious positive divergences starting to emerge on probably all of our major indices, probably many of the sectors, industry groups, and so forth, which off of that, we could see a blast off. So I think even a bad case scenario going back down to retest the lows ultimately might print some pretty positive technical news. So I just don't see this beginning to evolve into another downtrend, but I could be wrong. I've been wrong before. Like I said, I was wrong about the IWM the last couple of months. I'm really surprised that the small caps didn't perform better than they did. But you got to take what you see and move on. Scrape the pieces together, your puzzle, and kind of put it together again. All the pieces didn't fit quite right. And that happens. But from a overall market standpoint, my signals tell me we're going back up here in the fourth quarter. We'll see. All right, chart of the day. So if you like the chart of the day and you'd like to check us out over at Earnings Beats, go to earningsbeats.com. You can scroll down, and right here in the middle of the page, the Earnings Beats Digest. You can just simply put in your name, email address, hit the subscribe button. There's no credit card required. You may unsubscribe at any time. You won't hurt my feelings. We do this to try to help folks. Maybe a couple pointers that might help in your trading. You might already be a great technical trader. You may follow a technical analysis. You've been following it for years, but maybe there's a couple subtle things that we do that maybe will help. Or maybe you're somebody just starting from scratch and you're interested, you want to find out more about technical analysis, try and figure out how the market works. I think this is a great resource to help get you started in that path. This is the EB Digest is provided Monday, Wednesday, Friday. Usually comes out, we try to get it out around 8:30. Sometimes comes out a little bit later. If it comes out later, you can blame me. A lot of times it's my fault because I just don't get it out, don't get it done in time. But we try to get it out, let's say between 8:30 and 9:30 for the most part before the market opens. But again, it's just a way to teach you about some of the things that we like to talk about at Earnings Beats. You know, earnings are big, obviously, and our name is Earnings Beats. There was a reason for that name because we like companies that beat earnings. So we have a lot of focus on gap ups and earnings reports and testing gap support, but also some of the standard technical analysis that a lot of folks are used to, moving averages, you know, of course, price volume, breakouts, trend lines, all of that sort of thing as well. We get into intermarket analysis, some of the things that John Murphy has taught over the years. He's certainly been one of my mentors. I've had the fortune of meeting John and talking to him about it. I love his work, the intermarket relationship work that he did in a couple of his books. Really set the tone for me and my approach to how I look at the market. I love intermarket relationships. I love other areas like sentiment. I love seasonality, his history of the market. I do believe it repeats itself. Anyway, all of these things I try to talk about periodically through this Earnings Beats Digest. So if you want education, really good, solid education to help build your foundation or to increase what you do in the market now, this is a great place, a great resource. And so I hope you take advantage of it and sign up. When we do free events, we reach out to everyone on this subscription, everybody who's a subscriber to our EB Digest. We send out room instructions to our free events that we have. So we try to help the community as best we can. And so please take advantage of it. All right, today's chart of the day. Well, here's ZBH, which is Zimmer Biomet Holdings. And I'm giving you a 5-year weekly chart here just to show you, number one, while the market continues to go higher, this is one way just to take a look to see whether or not you have a stock that's, you know, among the leaders. I'll come right back to this, but let's take a look real quick at what the spider's been doing for the last 5 years. Do you see the more of an upslope from left to right? It's been rising. I mean, we had the 2018 trade war. We had the 2020 pandemic. We had the 2022 cyclical bear market, the inflation scare. We've had a lot of things on the spider, but ultimately we battled through it because that's what you do in secular bull markets. Meanwhile, here's a stock, ZBH, sitting at 105. Where were we 5 years ago? We were about 120. So here's a stock that over time is not keeping up. So just one quick glance at this chart, and I'm thinking, is this the kind of stock that I want to own? Now, maybe if I go back 15 years, 20 years, I'd look at a monthly chart, maybe it gives me a different picture. And that's the spider. I was going to say that does give me a different picture. The ZBH, it still has an uptrend. But does it historically outperform the S&P 500? No, for the most part, it goes along with it or down. So if you're trying to outperform the S&P 500 over time, just realize that you've got to catch one of these pockets where Zimmer is outperforming. You don't want to catch one of these pockets where it's getting hammered, which is what it's doing right now. But as I look at the chart, we go back to that weekly chart. Here it is. It's going sideways. You do have price support. And so price support on ZBH is down around 100. That's the recent low. That's after the pandemic rise, the post-pandemic rise that we saw a lot of stocks have. After that, the low coming back down, and throughout that 2022 cyclical bear market, we never went below on a weekly close below 100. And let's see, it goes back a little over a year. So if we pull up a daily chart and make it a 2-year chart, then we can go back on a daily basis and look at these lows. And again, somehow I've got the S&P still up there. There's ZBH going back the last 2 years. We have not had an open or a close below 100. So for those of you who like to play price support and key levels, ZBH is approaching what could be a buy. And if you're looking at the daily chart, you can see clearly right now, lower prices, higher PPO. We do have a positive divergence. I'd like to see some sort of a reversing candle, though. I don't want to see a big volume breakdown. That's not when I want to jump in with a positive divergence. I want to see a reversing candle. So what I'd like to see maybe is the stock continue to have weakness. Intraday, maybe move down to 98, 97, take out these lows and then reverse. Then you've got a test of price support with potentially a positive divergence in play. And then maybe it's a short-term trade. So that's the way I'd be approaching a stock like ZBH right now. Let's see. It's 9:30. So 9:32. So we are into the market open. Let's check it out, see what's going on. At the dashboard, relatively flat here. Small caps now have turned a little bit negative. So we've seen a little bit of a flip because small caps, an hour ago, small caps were leading in pre-market action on a relative basis. Now you can see they're actually a little bit below, and this is the group that's in the biggest trouble. Technically, they've been coming up, but remember, that was the chart, the IWM, where we are still down below that 20-day moving average. And you can see still, are we going to roll over, or are we going to hold yesterday's low? Because over the past 1, 2, 3 days, we put in higher lows. Is this just a quick move down and then they blast off through the 20, or are we truly rolling over and moving lower? I don't know. How about the QQQ? QQQ seems to still be going higher right now, up about 0.2%. Sometimes I'll go into this 10-minute, 5-day, just kind of get a feel. And right now, the QQQ certainly seems to be extending its rally. SPY, not as much. Maybe we got off of an uptrend, maybe a little bit of a cup here on the 5-day chart. So maybe a pullback down to 435 if we do go down this morning. If that's the low, and then we break back out, that would be a cup with handle measurement to 437 down to about 433. Let's call it about 441-ish. That would be the short-term measurement off of this 5-day cup with handle, if the handle actually does form. But you don't have to have a continuation pattern. The market could just keep going up. Or we could just completely blow through a handle and go back and test the low, and then the pattern's blown. So it's just something that I recognize visually. Once you do technical analysis a lot, you see a chart, things just kind of stand out. I see an uptrend. The first thing I do after an uptrend is I think continuation pattern. If I'm bullish, and as you know, I'm bullish. So I'm thinking continuation patterns on all time frames at this point, because I do believe fourth quarter we go higher. Anyway, let's go back to the dashboard. So hanging in there right around the flat level. NASDAQ 100 down here, you can see up just a little bit more. VIX, though, is down about 2/3%. So even though the market's coming back down a little bit, the VIX is still down. Not a lot, but it is down, continuing that move to the downside. And again, if it goes down another 1% from here, that would be the lowest level since September 21st, which was right after the Fed meeting. Anyway, let's go ahead and wrap this thing up. We'll continue to watch the market. I'll send out our daily market report later today to keep you posted on the action for all of our members after, the market digests this CPI report. Let's see what happens. But at this point, everything's been pretty much a go to the upside the past few days. Still looks pretty good to me, but we'll have stuff to kind of watch out for any kind of a rolling over. So again, talk more about that later today. Thank you all so much for tuning in to the YouTube stream. It's been growing. We certainly appreciate all of you tuning in and also sharing it with some of your friends, family. We'd love to reach a bigger community to help educate folks about really and truly the things that matter in the market, and not all the fear mongering that you're going to see on CNBC and all the other outlets. So again, thank you. Special thank you to all of our paid Earnings Beats members. This is why we're doing this and why we can do all these, a lot of these free events and so forth to help folks that maybe can't afford our service. So really want to thank those who do support us. And if you're on the fence, give us a try, 30-day free trial. Go over to earningsbeats.com. Right at the top, there's a 30-day free trial. You can come in, check us out. I think you'll be shocked by the value that we provide to all of our members. But you can get all of our services at no cost for 30 days. Why not check it out? Have a great day, everybody. Enjoy the rest of your week and your weekend. And we'll be back next Tuesday at 9 a.m. for your next Trading Places Live. Happy trading.